Pepsi stock is currently trading right at its lowest price in the last 5 years. And because of that, if we look at the company's starting dividend yield, they also have their highest starting dividend yield in over 5 years at above 4%. Now, if we look at Pepsi in the last month, they've enjoyed a nice little bounce up about 4.33%, but I will note that the broader market as a whole has also seen a pretty significant jump up in the last month, but it's great that Pepsi has been able to enjoy that bump as well. Now, Pepsi is probably one of the more talked about investments in the dividend investing community right now because it's pretty controversial. A lot of people seem to think that Pepsi looks like a massive opportunity. Again, we're talking about a dividend king stock, a stock that's been increasing dividends for 50 consecutive years, trading right at their 5-year low with a very juicy starting dividend yield, close to around 4.2% if you look at it on a forward-looking basis. But I will say there's a reason that Pepsi has been selling off, and there are still some problems on the horizon. And I want to preface by saying it might sound like I'm being a bit critical of Pepsi, but I assure you, I want the company to do well. While I don't own Pepsi in my personal portfolio, I do own SCHD, which if we take a look at the holdings of SCHD, one of the things we can see is Pepsi is one of their largest holdings, coming in at about 3.92% of the fund. So let's go ahead and dive in. Now, the first thing we need to make note of is Pepsi has an earnings report coming up next week. And keep in mind, their last earnings report was pretty disastrous. If we look at their upcoming quarter's earnings going to be announced pre-market on July 17th, we can see the EPS estimate is $2.03. And if we look at the earnings per share revisions in the last 90 days, we have 14 bearish revisions and 0 bullish. So expectations aren't exactly too high. And in their most recent earnings report back in April, the company had to cut guidance amid global trade uncertainty. In the earnings call, Pepsi stated that they see fiscal year 2025 low single-digit increase in organic revenue. Now, let's put that in perspective. If we go ahead and jump over to our profitability sheet, let's come up here and plug in Pepsi. And you can see all the data will automatically load into my spreadsheet thanks to the help of the ticker data add-on in Google Sheets. You can get access to any of these spreadsheets and the ticker data add-on that allows you to automatically import stock financials straight into your spreadsheet by going over to tickerdata.com. There's just a few days left in the independent sale where you can get 30% off the premium annual plans. Now, what we can see with Pepsi is that 10-year revenue CAGR is already sitting relatively low, only about 3.25%. So this is a slower growing business. It's pretty mature. And the same is essentially true with net income, only about 3.93% growth. If we go ahead and jump over to our stock screener, let's come up here and plug in Pepsi. What we can see is even on a per share basis, meaning including share buybacks, revenue per share still grew relatively slow over the last few years. In fact, in 2023, revenue per share is about $66.48. The following year, about $66.90, so less than 1% growth. The company also stated they expect total cash returns to shareholders of approximately $8.6 billion. Now, this is a very important number to keep in mind, and let me show you why. If we go ahead and jump over to our dividend breakdown sheet, we'll come up here and plug in Pepsi. Now, there's obviously plenty for us to look at here. Yes, the company has a great history of growing dividends. We already know this. The starting dividend yield is above 4%. And the dividend growth has actually been decent over the past decade for a mature company at about 7%. But again, we're going to have to keep going back to this number. $8.6 billion will be returned to shareholders in 2025. Why is this number so important? Well, the most important thing we have to understand as investors, and especially for investors looking to have sustainable dividend income, we have to understand capital allocation. Why is this so important? Well, I harp this all the time, but it's so important we understand this concept. When it comes to free cash flow, a company has 5 different options. They can reinvest back into the business, attempt mergers and acquisitions, pay down debt, do share buybacks, and pay out dividends. And what Pepsi just told us is they're going to directly return capital to shareholders with share buybacks and paying out dividends. And that means the company's going to be using about $8.6 billion to do so. But here's the massive problem we have to understand. Look at Pepsi's free cash flow. Look at it last year. It came in at $7.1 billion. Look at it the following year, $7.9 billion. In fact, look at their highest year back in 2015, about $7.8 billion. Pepsi is spending $8.6 billion to buy back shares and pay out dividends this year, and they've never even generated over $8 billion in free cash flow in a single year. So you might be asking yourself, how is this possible? And that's the exact question you should be asking. Well, really the only way is to weaken the balance sheet. Paying out more in dividends than you generate in free cash flow over the long term is not sustainable, and look at that free cash flow payout ratio over the last 3 years. 2022, 110%. In 2023, 84.3%. If we look in 2024, 100.56%. This is major red flags showing right here. And when you combine this with the fact that the management team just told us they're going to see low single-digit increase in organic revenue, I think it's highly unlikely the company generates enough free cash flow to cover that dividend payment this year. On top of this, the company just spent $1.65 billion on mergers and acquisitions. Again, that's another option for them to use free cash flow in order to invest in growth. And that acquisition allowed them to acquire Poppi. Now, pursuing acquisitions is something the management team at Pepsi has been talking about for a while now, and you can see the statement they made. It enables them to offer more positive choices to our consumers. They stated more than ever, consumers are looking for convenient and great tasting options that fit their lifestyles and respond to their growing interest in health and wellness. This is a huge focus for Pepsi. At least that's what the management team has told us. Consumers are becoming more conscientious of what they're putting into their body. And in fact, society as a whole is becoming more conscientious of this as well. For example, just in the last few weeks, we saw the governor of Texas sign a law that mandates warnings on certain foods. And if we scroll down, we can see Pepsi falls into that category. Obviously, not a good sign for Pepsi. So while Pepsi does have a very diverse product portfolio, they're looking to expand it to include more healthy options. But again, we have to go back to free cash flow. The company's going to return about $8.6 billion to shareholders. They just went through a $1.65 billion acquisition, and in 2024, the company only generated about $7.2 billion in free cash flow. It sounds crazy to say this for a company that's been around as long as Pepsi, that's grown their dividend for over 50 consecutive years, but if this trend continues, their dividend could actually be at risk. Now, before you get upset with me for making such an outrageous statement, I want to show you something. Around a year ago, I wrote an article for Seeking Alpha, and the article was on 3M stock, and the title was "A Dividend Cut is Needed and Could Be Imminent." You can see right here. It was written February 27th, 2024. At this time, 3M was a dividend king stock. They've been growing those dividend payments for over 50 consecutive years. And I got a lot of pushback for this article, a lot of negative feedback. For example, look at a few of the comments. I thought they just raised the dividend. A 3M dividend cut really goes against the DNA of the company. A 65% payout ratio, no dividend cut. I agree with the bulls. Why would they cut having just increased by a penny? 64 consecutive years of dividend increases and they just raised it. What am I missing? I could go on and on with these comments, and the point isn't to make anybody look silly, but there's many investors who don't understand the relationship between free cash flow, capital allocation, and paying out dividends. Now, with that being said, I don't think Pepsi is in the same situation as 3M. They have more hope than them to turn things around. But it's clear that the early warning signs are there. In fact, if we go ahead and jump over to my free cash flow analysis sheet, there's another concern that I have. If we go ahead and zoom in, let's look at the free cash flow analysis over here. What I want to focus on is this free cash flow margin. Now, what is a free cash flow margin? Well, this is essentially telling us for every $100 in revenue that the company generates, how much is becoming free cash flow. So we're starting from the top line and finding out how much truly makes it to the bottom line. Now, from 2014 to maybe 2017, it was around 11 to even above 12%. But we can see gradually over the past decade, this number has continued to decline. By 2018, 2019, we were in the 8 to 9% range. But over the last few years, it's gotten as low as 6.5%, and last year it was at about 7.8%. So yes, even though the company has been slowly growing revenue as we saw over the last few years, less of that capital is finding its way to the bottom line and becoming free cash flow. This is another concern that I have. So I know it sounds like I've been very critical of PepsiCo, but there's some serious concerns and red flags that we have to look at when analyzing this company right now. But with that being said, the stock is down 17% in the last year, and it's down significantly from its all-time high of close to $195 per share. So naturally, we can ask ourselves the question, is all of this already priced in? Is Pepsi actually a good opportunity due to the recent sell-off? Well, to answer that question, let's just go ahead and jump into our stock valuation spreadsheet. We'll come up here and plug in Pepsi. There's two main valuations that I want to look closely at. To start off, look at the historical multiples valuation. If we go ahead and zoom in, what are we looking at? Well, we're looking at the PE ratio for Pepsi charted out over the past decade. And what we can see is the average PE over the last decade is sitting right at 25.88. But if we look at it for the trailing 12 months, it's sitting at about 19.77. That's about 24% lower than the average PE ratio over the last decade. So Pepsi trading at a 24% lower valuation multiple than its average PE ratio. To some people, that's what screams a major opportunity, but there's a couple of things we have to take into account. Companies that are growing earnings and revenue at a higher rate generally warrant a higher PE ratio, and what we've seen from Pepsi over the last few years is slower earnings growth. So is a lower PE ratio justified? To some degree, I would actually say yes. Is a 24% decline justified? That's where things get a little more interesting. Finally, I want to look at the dividend discount model. Now, the idea behind the dividend discount model is we should be able to value stock based on how much it's paying out in dividends and how much that dividend is increasing over time. So, for example, if we jump over to our dividend breakdown sheet, Pepsi's been growing that dividend at close to around 6% over the last 5 years, and actually they recently announced a 5% dividend increase. So what if they are able to sustain that 5% dividend increase moving forward? Well, we could see based on that 5% dividend growth rate, the stock would be worth $164.63 per share, which is close to about 22% higher than that current share price. Now, the obvious question is, can they sustain 5% dividend growth moving forward? Over the long term, that obviously remains to be seen, but I can guarantee you this over the short term. They can't do that right now without harming the balance sheet. That's not an opinion, that's just the math behind capital allocation and free cash flow. So what's the company worth if they can only grow the dividend at about 2.5%? All of a sudden, it jumps all the way down to about $93.74, meaning about 30% downside. So if that dividend does grow really slow moving forward, then it looks like Pepsi could actually still be priced at a premium. So what does this tell us? Well, it tells us the market is still betting on a Pepsi turnaround. They still think that dividend will start growing at a healthy rate. Will that be the case? I still have my concerns. So what do you need to know? Yes, Pepsi's trading at its lowest prices in 5 years. It's trading at its highest starting dividend yield in 5 years. And yes, the company is a dividend king with 50 consecutive years of dividend increases, but there's some major red flags flashing, particularly when it relates to their free cash flow and capital allocation. For that reason, I can't find myself buying Pepsi stock right now. I don't want to have to buy stocks where I'm concerned about whether or not in the next 5 to 10 years they're still going to be able to pay a growing dividend. So is there opportunity with Pepsi? Perhaps there is some upside if those acquisitions they're making really start to pay off. But if we look at it on a risk-reward basis, this just isn't a bet I'm willing to make. I think there's better opportunities out there. So again, I hold SCHD in my portfolio, so obviously I'm hopeful that Pepsi will do well, but I'm staying away. But go ahead and let me know what you think of Pepsi stock in the comments down below if you plan on buying or selling. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.